Hello, Baker Investment students. It is Sunday, June 18th, so happy Father's Day to everyone. So hope your weekend's going well. For this week, you're going to be reading chapters 7 and 8. Continue with the forum discussion. Good job with those again. Hopefully we'll have a good week this week. Like I said last week, the Fed did raise interest, or stayed with the interest rates they did raise, but kind of hinted at possible rate increases in the future. So it's going to have to check inflation, see how things are going. But Thursday was a pretty good day. Friday was down a little bit, but we'll see what this week holds. But again, forum discussion, the homework, and then again, the main thing I also want to point out is we do get a break in this course in the week of July 4th, but also be thinking about that time to kind of you have some writing assignments due at the end of the course, weeks 6 and 7. So that might be a good opportunity to start doing some of the rough draft and getting that done, so you don't have so much to do at the end of the course. And of course, work on that now too. So, all right. So a little bit of insights for this week. You think about it. Halfway through this week, we're going to halfway done with the course. So these courses move so quickly. So just stay on top of things. But you're going to look a lot at stock valuation this week. And when analyzing stocks, I remember from back when I was in graduate school, my professor told me that you always look at the economy first. Obviously, the economy right now, it's still doing fairly well. The Federal Reserve is trying to actually slow the economy down because inflation is so high, and that can have wealth effects. And that is a major concern. Does it mean that some people are going to lose their jobs? Absolutely. But we have prices continue to spiral out of control, and we have a little bit of what we almost call like wage price spiral. I am going to receive, I work for the state of Missouri, so I'm going to receive like an 8% raise, but as those raises go up, it also means that prices go up too. So it's a little bit of a dilemma right now too. People need to have their wages adjusted to keep up with inflation, but it also at the same time keeps pushing inflation up. So the Fed's in a little bit of dilemma right now, and it hasn't been that way because we've been in such low interest rates for a long time. But still, demand is fairly strong in the economy, but there have been some firms that are starting to see some layoffs. So we'll kind of see what happens here the next year, and whether I would prefer that interest rates start to drop a little bit. I know my bond funds have just been it's been brutal the past few years with just the rise in the interest rates and the valuation of bond funds because they work in an inverse relationship. But with that, the next thing you always look at is that industry. I know from one of your forum posts, you mentioned about the airline industry being very strong right now. I think there's a lot of pent-up demand. People couldn't travel during COVID. So even though maybe the ticket prices are still relatively high, people are still traveling. There's still a high demand for those tickets. So industries will vary depending on how well they're performing, what's trending, whether it's anything from pharmaceuticals to airline industries to manufacturing. It will vary, but you want to look at that industry too. And then finally, you look at the company specifically. And that's what a lot of the chapter 7 and 8 start to look at. You start to look at what we call like fundamental analysis. Now, fundamental analysis is what most economists and finance people would say that, hey, really, you need to be looking at the fundamentals. What are the ratios? What is the valuation of this company? To me, it's always about cash is king. So there's no guarantee on future cash flows for any company. Something can go bad. You kind of saw that with the whole Bud Light dilemma, and just how interesting it is today with media and influencers and trying to change demand, or if you're not on the right side of a certain, I would say, in the way of people are thinking, you saw how it kind of got Bud Light and quickly in trouble, and their sales have dropped like 25%. So, there's no guarantee of future cash flows. But in fundamentals, you're obviously looking at the financial ratio of these companies, and you're also going to be looking at like projecting out what these potential future cash flows are. To me, bottom line, the value should be based on the present value of those future cash flows, given whatever opportunity cost there is. And the textbook reintroduced that idea of the capital asset pricing model, the risk-free rate plus beta times the difference between market return and risk-free return. So, but again, like I said, the big unknown is what's going to happen in the future of this company. Are the cash flows going to be consistent? There's been some companies been around a long time, like McDonald's has been around for a long time. I wish I had bought McDonald's about 20 years ago. I'd be on a beach with a fruit drink right now. I think they're trading well over $200, and about 15 years ago, McDonald's stock price really wasn't doing that well, but they've really turned things around quite a bit. But nevertheless, you're going to be looking at these different methods, especially a lot more in Chapter 8, looking at maybe a dividend model, everything from like PE or earnings per shares, or, the price of the stock relative to the book value. So, but to me, still bottom line, it's all about projecting future cash flows. There's different techniques you can use. And the interesting thing is, I've talked to analysts over the years, and that's one of the things you're going to look at your forum discussion post, what analysts are saying about stock. But nobody's ever completely right. They just don't know. And that kind of gets back to the idea of efficient market hypothesis. If the markets are truly efficient, why do all this analysis and everything? Because it's whatever that stock price is today should be reflected in the market, as you have thousands of people are they analyzing the same thing about the valuation of this company. But the interesting thing is that people get it wrong, and there are stocks that are overvalued and there are stocks that are undervalued. So hopefully you're finding those stocks that are undervalued based upon your fundamental analysis and the research. So what makes one fund manager better than the other? Whether is it luck, or is it they truly are doing a better job of analyzing the true value of these companies? So, all right, well, that's it for this week. So if you do have any questions, do email me. I do believe I should have everything graded for tomorrow. You guys are a small cohort, so it's pretty easy to get through things and get them graded. But again, please do reach out to me if you have any questions. And other than that, have a great week, and we'll see how the market does this week. Look forward to talking to you online. Take care.